Pricing is literally the most important topic in all of quantitative finance and financial engineering. It's literally what determines whether you make money or lose money. More so, retailers rather than institutions tend to focus on this idea of a trading strategy. What's your trading strategy? I want to build an algorithmic trading bot that's going to print money for me. And you mention anything on pricing, and crickets. Nobody has interest, but pricing fundamentally is necessary for those topics. If you don't know what the price is should be, then how can you ever hope to make money? At best, you're going to break even, or you're just going to lose money. The goal is to find things that are undervalued and buy them, or overvalued and sell them. And you do this on a statistical basis, right? It's not about certainty. There is no certainty. You're doing this on a statistical basis to accumulate edge, positive expected value over time. And if you can do that, you generate P&L. If you don't, then you lose money. So pricing is the most important thing. It's not about your trading strategy. Your trading strategy is fundamentally trying to figure out what is over and under price. That's the whole point of it. So in this video, what I want to do is I want to apply this idea to exotic options. I want to focus on the pricing of these exotic options and how a desk may go about producing these prices, focusing on this idea of ensuring that we have some sort of edge so that we're making money, making a market with these products rather than, just giving money away without any interest in how pricing works. And we're going to visualize this general methodology step by step. This Jupyter Notebook is linked in the description below. I've also outlined a set of prerequisites. I created a video last week on the Black-Scholes implied volatility surface. It discusses why the Black-Scholes model is insufficient to price these products. Definitely check out that video. I have other relevant videos here too, like why we can simulate prices, like how does that even work, why we care about pricing. I kind of just mentioned it because your P&L at the end of the day is just how well you identify mispricings. I also have more theoretical videos on the underpinnings of generating these prices. Unfortunately, they tend to be my least popular videos, but they are the most fun to make. So definitely check those out if you would like more of a technical background. Moreover, if you're more interested in the practitioner, or if you're a practitioner more interested in the application, I have these applications of these models from a market participant, market maker perspective, and you can check out those videos there. So we're going to focus on this idea of pricing and specifically pricing an exotic option. So our goal is to generate P&L, right? First, what the heck is an exotic? So if we have a European option, right, that's typically what we call a vanilla. It has this standard payoff. We have the right but not obligation to buy or sell at a certain price at some time in the future, whenever the option expires, right? There are a lot of exotics that are just Europeans with different payout structures that tend to be path dependent. So a European option, it doesn't matter what asset path. It doesn't matter the path the asset took to get to the expiration. But with the barrier option or the cliquette option or other exotic options, the path does matter and it impacts the payoff at expiration. So what we're going to do is we're going to focus on this idea of a barrier option. It's just like a regular European option. So here's a European call, for example, right? We have a strike price. The underlying asset expired above it, so we get a payout. In this case, it was 589. If I run this again, right? Whoa, what happened here? So the underlying asset expired in the money, right? It expired above this strike price. But this is not a European option. It is an exotic. It's a barrier option. It hit this barrier. This is an up and out call, which means if it hits the barrier, you're done. No P&L. It'll expire worthless regardless of if it's above or below the strike price. So that is a non-standard payoff structure that is now path dependent, right? It depends on the path that the underlying asset took. Very interesting. How do we go about pricing something like this? First, why would we buy this or sell this? Well, what if I have an opinion on the underlying asset? I think that it is, let's use NVIDIA for example, right? It's 170 about right now. I think NVIDIA is going to be 190 in 10 days, but there's no way it's going to be above 200 within those 10 days. Well, I can structure a barrier option to facilitate that position, right? I can put the barrier at 200 and then I can just ride out that call and hopefully I'm right and I can make money. So why would I do that if I have this extra risk? right? Because if it hits the barrier, then it expires worthless regardless, right? Why don't I just buy a vanilla call? Well, for that extra risk, you're going to get a discount, right? Because you have more risk of it expiring worthless. There's less upside potential for you with this barrier, as made evident here, right? It hit the barrier and you don't get to collect this payout. So it's going to be cheaper relative to its European counterpart. Okay, so that's how we can kind of look at this exotic option. We can look at it relative to what we know, and that is a standard European option. How do we go about pricing something like this? Remember, our goal, or we're sitting on a trading desk, right? I gave you an example where we're trying to, make some sort of speculative position on NVIDIA. That's where I'm trying to buy the contract, right? What if I'm on a desk and I'm making a market for this contract, right? What's my goal? Well, my goal is to price this fairly and then make adjustments for my counterparty risk, liquidity, and of course, profit, and then hedge away as much of it as possible so statistically I can make money over a large series of trades just like this one. That's my goal if I'm sitting on a desk. So this methodology, this general recipe, if you will, is going to facilitate that goal, right? Pricing. Pricing is the most important thing in all of quantitative finance. Goodness gracious. Step one, okay, in this general recipe to price something like this barrier option. Select a model. Okay, clearly Black-Scholes is insufficient. We'll briefly discuss why, and we'll talk about other models. Step two, determine a vanilla pricing scheme for that model. Very interesting. Wonder why we're going to need that. Step three, calibrate the model. It's going to ensure we produce consistent prices. Step four, determine an exotic option pricing scheme given the parameters from the model that was calibrated. Okay. And then step five, just as I said, we're going to apply some pricing adjustments and then we can go ahead and send that quote. Let's first talk about this first step here. All right, model selection. Black-Scholes is insufficient. All right. Why is Black-Scholes insufficient? Well, in the video last week, I talked about how the Black-Scholes model allows us to produce a price based on a volatility level. But that volatility level is not consistent for the prices that we observe in the market. If that doesn't make sense, just look at these two surfaces. All right, this is a Black-Scholes implied volatility surface, and this is the market implied volatility surface. What I have here is a set of 5 strike prices, 5 time to maturities, same set on the Black-Scholes implied volatility surface, and you can see that they do not look the same. The Black-Scholes surface is flat. It assumes a constant volatility for all of the options. Each point on this grid is a different option contract. But the market surface requires different Black-Scholes implied volatilities to produce the market prices. Why is this the case? Well, as we talked about in the previous video, fear is on the downside. We're not going to get too much into that, okay? But if we are using a Black-Scholes model, what do we have control over to change the shape of this volatility surface? Well, we can change volatility. I can increase it. Oh, it raises the surface. That's not helping. Does not look like this. I can decrease it. That's not helping either. Still doesn't look like this. We can't change the shape. We can't change skew. We can't do anything, okay? Volatility is constant. So we need to go beyond Black-Scholes, okay? What is the problem with a flat surface if the market looks like this? Well, we're just subjecting ourselves to arbitrage. So here's the skew, the market skew. This is the Black-Scholes volatility. These do not match, right? This is just a cross section of this surface, right? These do not match. We're subjecting ourselves to arbitrage. If I quote prices for my desk with this Black-Scholes volatility, and this is the market surface, that's just immediately arbitrage. I'm subjecting myself to arbitrage. Look at this put. The put that I'm quoting is severely underpriced relative to the market price. Severely. Look at that gap, right? So we never want to subject ourselves to arbitrage. We don't want to give away money. Over time, we're just going to get killed. We want positive edge. We want to accumulate positive expected value over time. That's our goal. So Black-Scholes is insufficient, clearly, right? What are some extensions? Well, let's first talk about what we mean when we say a model framework. Something like Black-Scholes, when we say we're using a Black-Scholes pricing framework, all that means is we're using a geometric Brownian motion as our stochastic differential equation to govern the dynamics of the underlying asset. So an option contract is, let's just look at equity options, written on a stock, right? We're assuming that the stock is a random path that evolves randomly over time according to this equation. It's prescribed randomness. It's really all it is. In this particular equation, volatility is just a constant, right? So we need to extend this model. We could look at something like a local volatility model. That makes this volatility term a function. It's no longer constant. That's going to allow us to fit this surface to the market surface. Another option, pun intended, if we don't want to use a local volatility model, is to use a stochastic volatility model. And in this case, this stochastic volatility model is called a Heston model or a Heston framework. And what it does is it just assumes that volatility follows this random process, this Ornstein-Uhlenbach process, which is a mean reverting process. Not a crazy assumption at all to assume that volatility is a mean reverting process. But really what this does is it introduces these new parameters, right? In a Black-Scholes framework, we only have that volatility term. But in a Heston framework, we have all these other parameters for the volatility process that we can change freely. How is this useful for us? Well, let's take a look at the skew. Remember, if we go back up to this chart here, if we use a Black-Scholes model, poor Black-Scholes down here, it's all flat. It doesn't fit the market skew. But let's look at a Heston model. That green line represents the Heston skew relative to this blue line, which is the market skew. And again, poor old Black-Scholes is assuming constant vol down here. But this is certainly more in line with the market prices. But we haven't even gone about tinkering with the parameters yet. So this is very similar to Black-Scholes in the sense that you give me these parameters, I can produce a price. And from my previous video, you'll know that we can just produce an implied volatility if we can produce a price. That inverse is 1-to-1 in that sense. Here, what we're doing is we're producing a price. And we're producing an implied volatility for this particular parameter set. And we can change the parameter set so that it's in line with the market skew. So watch this. If I go and change, let's see, one of the parameters is theta in the Heston model, the long run variance. What happens if I increase it? Let's increase it. So this is 0.06. Let's run it again. Look at that. It shifted it up. 0.08 shifted it up. So I'm going to be able to tinker with these parameters of the Heston model to fit the model to the market surface. And that's exactly what our goal is going to be. So this is why we need a model other than a Black-Scholes model. We need to go beyond the Black-Scholes model so we can produce consistent prices in that capacity. This is certainly putting the cart before the horse in the sense that if we're able to produce the implied volatility for a Heston model, it means we already have prices. The particularly keen among us will remember from last week's video where I talked about trading with the Black-Scholes implied volatility surface. If you have implied volatility, you already have a price. It's 1-to-1 in that sense. You can go back and forth freely. But I never talked about how to get a Heston price for the European options that make up the implied volatility surface, right? So let's look at the flow here, right? I chose a Heston model. I then pick the parameters of the Heston model, which includes the contract parameters, right? So I can use the Heston model to produce a price for each point on this grid. And it's going to give me some sort of volatility surface. It's not going to be flat, but it's certainly not going to be the market surface because I don't know what parameters to pick, right? So my goal is going to be to pick the parameters in such a way that it fits the model to the best of its, or fits the market volatilities to the best of the model's capability. But in order to do that, I need to be able to price the options. Because if I can go back and forth freely between price and implied volatility, I need to get one of them first, and that's price. I need to generate a price first. Then I can go to the Black-Scholes implied volatility, and I can try to match this market implied volatility surface. Okay, so how do I generate a price for a Heston framework? This is certainly a lot of notation, but I'm just gonna talk about it. So there are essentially three key ways I want to talk about. The first is we can construct an argument similar to Black-Scholes, where instead of the source of randomness only being the underlying asset, I also have randomness coming from the volatility. So I can construct, instead of just a delta hedge, which hedges away the underlying randomness, I can construct a delta hedge and a vega hedge. Specifically, I do a vega hedge first, then I do a delta hedge. And what that's going to do is it's going to cancel out the randomness in the stochastic differential equation. And then it's just going to produce this partial differential equation. And I can solve this partial differential equation numerically using a computer, using the finite differences method or however you choose. That's one way to go about producing prices. Another way is to use Karmatin, FFT, fast Fourier transform. That's a fancy trick to make it like a quasi-closed form solution. And another way is to just use simulation. So I certainly encourage you to check out, and I link the video here, and I also link it at the top of this Jupyter Notebook. You can check out how simulation pricing works. It's the exact same way in the Black-Scholes framework as it works with the Heston framework. And I also talk about how we can go about deriving the partial differential equation in the Black-Scholes framework, and the extension to the Heston framework is exactly the same as well. So certainly encourage you to check those videos out for more background information on how to produce European option prices with the Heston framework. We haven't even gotten to producing exotic option prices yet, but we need to produce the European option prices first so that we can fit the model to the market surface. Then we can produce the exotic prices. So what I have here is I have some notation discussing the pricing. And really, we don't got to get too much into the weeds. I usually save that for videos on Tuesday where I talk about, more technical subjects. But here, what I'm trying to say is the prices that we generate in a simulation capacity, and that's the method we're going to focus on because we can actually then see where the underlying asset hits the barriers in this exotic option that we're trying to price. All I'm trying to say in this, math notation is that we are approximating the price in this framework. It's not a precise price. And the reason why I like this notation is because it's consistent with other videos that I've done on using neural networks to approximate these pricing functionals to increase the speed of pricing and calibration, which we're going to talk about in a moment. So we're focusing on this idea of Monte Carlo simulation. We can use Monte Carlo simulation to produce prices for our Heston framework. Once we produce a price for a Heston framework, we can look at the skew, see how close we are to the market skew, tinker with the parameter, check the Heston skew again, tinker with the parameter, and just do that iteratively until the green line fits the blue line. That means we're quoting consistent prices. So that step that I just outlined is called the model calibration step. Okay? And I'm going to do an entire video discussing this calibration step because really we're solving this minimization problem here. And this minimization problem is just literally taking the Heston parameters given by the Heston framework, and it's finding the best set of parameters that fits this surface in the Heston framework to the market implied volatility. So we want the Heston volatility surface to look as close to the market implied volatility surface as possible, and here's what it might look like as it starts to approach the market implied volatility surface. So this is a Heston implied volatility surface. This is a market implied volatility surface. This certainly does not look flat, right? The Black-Scholes volatility surface was flat. This certainly does not look flat, but this parameter set that I've chosen did not generate a volatility surface that was super consistent with what we've observed in the market. So I'm going to want to go back and tinker with those parameters. So how do I tinker with them? Well, I can use a lot of different minimization algorithms and schemes to go about minimizing the error between each point on this surface with the market surface. And that's going to let me change those parameters in the Heston model to find what I'm calling this theta star. That is the optimal set of parameters for the Heston model that fits the market volatility surface. And again, the reason we need to do that is to ensure that we're quoting consistent prices and we're not exhibiting arbitrage. There is a big efficiency concern if I'm using Monte Carlo simulation because every single time I produce a volatility surface, I'm running a Monte Carlo simulation, and clearly I'm not going to get it right on the first time, right? I'm going to have to keep tinkering with the parameters. So imagine I run a 100,000 path simulation, and then it doesn't fit. I have to run another 100,000 path simulation, and if that doesn't fit, I have to do another. So again and again and again, and I have to keep using Monte Carlo simulation to go about producing those European prices. So typically other schemes are favored for efficiency because the calibration process is iterative. I produce this surface, and then I have to produce another surface and another until it gets closer and closer, and I choose the right set of parameters that fits the market surface. Okay, so for this video, I'm not going to go too much into the model calibration problem. I'm going to assume that we've solved this minimization problem and we've found the optimal set of parameters. Now we're ready to go about pricing the exotic option outlined at the start of this video. So let's try to get our full picture, right? So we said we have this up and out barrier option, right? What that means is if the underlying asset hits this barrier, it's worthless. If it expires underneath the strike price, it's worthless. But if it's within the strike price and barrier range at expiration and it didn't touch the barrier, then we're going to get some sort of payoff. We can represent that statistically as this function here. This function here in the Heston framework, this risk neutral expectation. And I can solve this numerically using Monte Carlo simulation. All I'm going to do is I'm going to simulate price paths in a Heston framework. And I'm just going to keep track of the ones that expire with a payout relative to the ones that expire worthless. And then I'm going to discount their payout back to the present and then take the average. And that is going to be my option price. Now, one of the things that we are certain of is as these sample paths increase, we're going to produce more and more accurate prices. So let's take a look at 10 sample paths. We get a barrier price of 0.4273. Well, we're not very confident in that price, right? If I was to run that again, I get 1.0078. That's not a lot of confidence. So let's increase the number of sample paths. As you can see, as I increase the number of sample paths in this Heston framework, remember this Heston framework is assuming that the underlying asset's random and the volatility is random. You can see that some of them, the green ones, are expiring in the money and they didn't touch the barrier, where the red ones hit the barrier and the yellow ones, they expired out of the money, so below the strike price. As I increase the number of paths, I'm going to get a more and more and more accurate price. What did we say at the start of this video? This certainly has to be worth less than a European call option without the barrier, right? Because we have that risk on the upside now of it expiring worthless. So let's take a look at a European call in this Heston framework, right? So I have the barrier price here, and this is the price of our exotic. It is going to be $2, roughly $2.13 in this case. Let's take a look at the call option in a similar Heston framework. 1031 or 1032 roughly, right? See, 10,000 steps, 1057. So we get a significant discount, and that makes sense because if we ride this upside here, we're going to hit the barrier and it's going to expire worthless. So I got to pay much less for this exotic option, right? I'm going to pay much less relative to the standard call, the standard vanilla call option. So this is how we go about pricing an exotic option. But we're not done. We found this risk neutral price. That's not the price we're quoting, right? We need to make some adjustments to this price. Once we have this model price, we need to think about different things like what is the current state of the market? We need a counterparty risk adjustment. We need a liquidity adjustment, some sort of profit margin. We can decompose the price that we're quoting into all of these different components. That risk neutral price, there's no way that's the final price that we are quoting, right? Remember, pricing is the most important component of quantitative finance. If you don't know that something is over or undervalued, then you're already losing, right? You're already in a losing position. You need to ensure that what you are buying or selling has some sort of edge in either direction, right? You need to make sure that you're buying cheap, selling high, buying back cheaper. That's the whole goal in this space. So when we decompose the price into these different components and make all these adjustments, that's what we're ensuring. We're ensuring that if we quote prices for this option and then we hedge away the risk, then on average that edge for making that market is there for us and we can profit if we make this type of trade a significant number of times. And that goes back to the pricing consistency argument. If we're not producing consistent prices, so if we're using something like a Black-Scholes framework and we're not producing consistent prices, then that edge that I'm talking about, that theoretical edge that we should have in this type of price that we're quoting, there's no way we're going to have that if we're using a model that is producing inconsistent prices. So once we go about selecting a model, fitting it to the market volatility surface after we've decided how we're going to produce vanilla prices, we find the parameter set for the model that we've chosen. Then we go about simulating exotic option prices. we can then make adjustments and then fire off that quote on IB to our clients and make a deal. Some closing thoughts going over this general recipe again and some future topics. Remember, this general recipe demanded model selection because we need consistent prices so that we can accumulate edge. Heston model is going to ensure we can quote consistent prices. We need to determine how we're going to produce the vanilla option prices for the model we select. In this case, we did simulation. We then calibrated the model to the market surface. In this case, we didn't go about solving that minimization problem. We just assumed that we could solve it and find that theta, that parameter set for the model we chose. Then we determined how we would go about pricing the exotic option. In this case, we chose simulation. Then we applied some price adjustments and we fired off that quote and made a deal. This subject covers a lot of topics. Pricing exotics is not a trivial task. There are a lot of related topics in pricing theory. I would like to talk more about, diving deeper into stochastic calculus, talking about different forms of stochastic differential equations, intractable solutions, ones that require numerical simulations, different discretization schemes, and other fancy tricks that we can use to approximate these pricing functionals. Like the Heston FFT, I'd like to do a dedicated video on the fast Fourier transform for the Heston model where I talk about the that paper, that Carr-Madden paper. Efficiency, as I mentioned earlier, right? This is a terrible bottleneck in the calibration problem. If you have some model that is like path dependent, think about like something like a rough volatility model where the entire structure is non-Markovian in the sense that like you need to decompose some sort of covariance matrix and then iteratively discretize the integral. You are going to have a terrible bottleneck because it's iterative, right? So you need to simulate those paths and then try to fit the parameters, simulate those paths. It's a terrible bottleneck. So there are models, alternatively, like to a Heston model in a stochastic volatility world, not necessarily extending to the rough volatility space, but like something like a Sabre that has like asymptotic solutions. I'd like to do a video discussing those. I'd also like to talk more about these functional approximations using neural networks. It's a very interesting area in the academic literature. A lot of work is being done with deep learning, neural networks in that space right now. Hedging, pricing, all of that is being done with different types of neural networks and artificial intelligence, machine learning, whatever you'd like to call it. I want to talk more about simulation too. Why does simulation work, right? Like we just assumed that it would work to generate these prices here. We kind of assumed. I've done a video in the past discussing Monte Carlo simulation and Black-Scholes prices and why they converge, but I'd like to extend that to make it more abstract and discuss why it works in general. And we haven't talked at all about book management here. We haven't talked about making adjustments to our simulated price in a discretionary capacity, or how do we even dynamically hedge a portfolio of options, right? I talk about that Heston model and a Black-Scholes argument where we do a vega hedge and a delta hedge. What does that even look like in real life? How do I conduct a vega hedge, right? If I want to hedge vega and delta, what does that look like? I have to use an option and then I need to make the delta associated with the portfolio. After making my vega neutral, I need to make the delta neutral. So there's a lot of different components of this. So all of these are topics I'd like to cover in future videos. That being said, I hope you enjoyed this video. This certainly was a challenging video to make. This was a long video to record, and this notebook took a lot of work. So I hope you enjoyed. I hope you learned something. Definitely leave a like, subscribe, comment if you enjoyed. Check out our Discord. Check out quantguild.com. It helps support my videos and it lets me keep making them. Other than that, thank you so much for watching, and I will see you in the next video.